The Foreign Investment in Real Property Tax Act, or FIRPTA, presented by La Tax Law. The best way to explain FIRPTA is through an example. Assume Susie is a foreign resident who would like to invest in the U.S. real estate. So Susie purchases a building. Susie spoke to a tax professional who informed her that foreign nationals are not typically taxed on capital gains if they own stocks. Thus Susie sets up a U.S. corporation, Susie's Co., to hold the building. After 7 years, Susie sold her stocks in the building. With a basis of $1 million, Susie received $1.5 million for the disposition. Recall, foreign nationals are typically not taxed on their capital gains from the disposition of stocks. However, this rule does not apply when U.S. real property interests are part of the transaction. FIRPTA reclass non-taxable gains to taxable gains, and it does it through withholding. When a foreign seller sells his U.S. real property interest, the buyer must withhold some of the proceeds and remit it to the IRS. For FIRPTA to apply, you'll need 3 elements. A foreign person who recognizes a gain from the disposition of the U.S. real property interest. Each of these elements are broadly defined. Once you have all 3, FIRPTA becomes the default, unless an exception applies. If the buyer fails to withhold, then he will owe the IRS for the amount, not the foreign seller. The difficult part is figuring out the calculation and the withholding. At La Tax Law, PLLC, we'll be with you every step of the way.